So what most people are thinking about right now is that Tax Cut and Jobs Act that was passed in December of this year. How is that going to impact markets in 2018? And then maybe also you could give us your views overall about the market outlook for 2018.
Okay, so 2017 was a fantastic year for equities. One of the best years since 2013, and one of the things we also saw was very, very low volatility. So the market really didn't have any pullbacks over the course of the year. 3% pullback was the most we had. So that makes, over the last 30 years, this is the least volatile market in 2017 that we've had. So from an investor standpoint, we probably feel pretty good about things. One thing I know for sure is volatility will pick up next year. We're going to see, in 2018, we're going to see more volatility because we're coming off such low levels. So investors, first of all, need to get used to the idea that we're going to have more ups and downs and more volatile moves as opposed to that smooth upward trajectory that we had before. The reason stocks moved higher over the course of the year was the economy's doing better. Earnings are getting better. Everything looks pretty rosy right now. I think the biggest risk that we see going into 2018 is if things are too good, the Federal Reserve is going to have to start raising rates probably even faster than the 3 rate hikes that they projected. You don't need low interest rates when you have 20, 30-year low on unemployment, when you have inflation starting to pick up because of wage pressure. So we're in a situation where if the economy does too well in 2018, I think you're going to see a little bit of a dampening by the Fed. So I'm not anticipating the type of returns that we saw in 2017 and 2018, despite the fact that the Jobs Act did get passed. We saw a little bit of a bump. I think there's still a little bit more to come from that. But I think overall, I don't think it's going to add a ton. And investors should probably prepare for maybe high single-digit to low double-digit returns in the U.S., about half what we got in 2017. On the other hand, international markets still look great. And rates are going to stay low there. They're not going to, ECB and the Bank of Japan are not raising rates. Earnings are improving, the unemployment outlook's improving, and they're earlier on in the cycle, and valuations are more attractive. So from an investor standpoint, you may be able to get really solid returns, but the majority of that may come from international and less from domestic as we see going forward. Don't anticipate making much money in fixed income either. I think rates are going to continue. I think the Fed is going to raise rates 3 times, maybe 4 times this year because we have very, very good fundamentals. And again, if they get much better, the Fed's going to have to get more aggressive.
That's perfect. Thanks so much, Darren.
Thank you.